would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to Wednesday, folks. You've made it halfway through. Congratulations. There's a light at the end of the tunnel. You're almost there. You are at the peak of the week. I kind of like that one. Before we jump in today's stories, though, I want to remind everyone how to get in contact with me. The best way is to hit the website at therebelbroker.com. Feel free to click the contact link in the menu bar, and you'll be able to send along any ideas, suggestions, observations, or questions that you might have. Happy to hear them. There's also a little red button at the tippy top of the page titled Take the Survey to Support the Show. Give that a click. Both times you're asked for an email address, use the same email address, answer a few demographic style questions, and you have helped support the show. And to show my gratitude, I will be putting your email address into a drawing for a $50 Amazon gift card. That's right. You're not just helping the show. You're also giving yourself a shot at a $50 Amazon gift card. We've already given this thing out $250, $300 worth. I've lost count. So we've had quite a few winners. We're going to be doing it again at the beginning of April. So we're coming up on the end of March. Get yourself involved and give yourself a chance for that $50 Amazon gift card. Also, for those of you who would like to get a little bit more of the inside scoop, now I'm not someone who abuses folks who join my mail list. Anyone who's currently a member of the Rebel Underground can attest to this. You don't get daily emails. You don't get weekly emails. I don't sell your contact information to anybody. I don't give your contact information to anyone. The only emails I think that I have sent out so far have been the welcome to the group email, which everyone gets when they just to be a verification that you've made it. And the other one is to let everyone know about the exclusive content that's available only to members of the Rebel Underground. Right now, that's one video about how to dial down into a little bit more of a detailed look on what parts of a larger metro or city area you might want to focus your attentions on as an investor. There is a new video that's going to be coming out sometime over the next few weeks. I'm going to start working on it this weekend. That's going to walk you through the process of analyzing a specific property. So those two videos will fit together nicely in terms of creating a path for you to get right down to, does this property work for me, with the specific details that you review. In addition to that wonderful stuff, I'm entertaining the idea of doing a regular segment on the show, and I would love to hear back from all of you. Now, before I jump into telling you about that, let me tell you how to join the Rebel Underground, because I didn't just do that. You can text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to the number 44222. Now, I'm also going to be adding a button on the website for you to join the Rebel Underground that way. But for right now, the easiest way to do it is to text the word Rebel Broker, all one word, to the number 44222. Okay, so now that I've gotten that taken care of, let's loop back around where I was talking about hearing from you, because here's an idea I came up with. I would love to see what you guys think. I think it could be fun, and it would also make it a way for you guys to sort of reach out and provide me with a little feedback on things you'd like to hear about. So let me see what you think of this. I was thinking maybe once a week, maybe once every other week, maybe once a month, whatever level of repetition makes sense. I would take a community, a city, or metro area that you all suggest and head on over to it, go through the process of analyzing it, figure out the areas I'd be interested in that would just draw my attention, and take it all the way right down to finding one or two properties and going through the process of figuring out if they made sense. Now, of course, this would all be the at a distance analysis, where you kind of drill down, you see if you can find multiple properties that make sense for you, all based on what you can learn from your desktop. This would include doing some of the general things we've talked about, and also some of the things we've done when we've analyzed some communities in terms of hints or clues that you might get that you want to do a little bit more research into different parts of that area to find out what different influences are. And it might include interesting statistical things that you're noticing on how things are shifting, that kind of stuff. But I figured it would be a fun thing to do. It would be a great way for you to either leverage off of me doing that for the benefit of everyone, or let's say you consider yourself to be a pro in this particular community. You could throw that to me as a challenge and say, hey, you go do what you're going to do, and let's see if you come up with the communities that, with my years of experience living here, do end up being good investment areas. I'm happy to take on that challenge because if I end up not picking the right areas, hopefully the information I will get from you will make me better at doing this. And by doing it in front of everybody, we all learn from the experience, right? So it's all good. So feel free to reach out to me about that one. The best way to do it's going to be through the website, as I mentioned before. So head on over to therebelbroker.com, click on contact in the menu bar, and give me your suggestions. What do you think? What communities would you like to see me take a closer look at and jump through that analysis process to see what comes out the other end? So feel free to jump in and provide that if you're interested in helping out the show with some content. All right, so first for today, we're going to hit a story that fits nicely with what we were discussing yesterday. If you'll remember, we were discussing the rate at which folks were leaving different communities. In terms of rate, Chicago wasn't number one, but in terms of the sheer numbers of people, with over 66,000 folks deciding they no longer wanted to live in Chicago. And that's a net loss, right? So they've already calculated in folks who've migrated in, and then a net loss of 66,000 folks in Chicago. And I had mentioned how Chicago had also made an appearance in other things we've discussed, saying what a great place it is to invest. So today, what do I see but an article from Home Union titled "Chicago's Investment Housing Sector Among the Nation's Hottest." Quote, let's see here. Let me skip down to the sexy bits. Chicago is one of the hottest single-family rental property markets in the nation based on three separate rankings, including in its 2017 National Single-Family Rental Research Report. Chicago ranks number 1 in the Upside Potential ranking, 5th in the firm's Opportunity ranking, and 6th in its Cap Rate ranking. Upside Potential measures the strength of markets that have been slower to the housing market recovery and therefore still present strong investment opportunities for investors, while the Opportunity ranking identifies markets with favorable entry prices and limited threats. The Cap Rate ranking measures a property's operating income divided by the price. When they decided to make this feature so highly here in their estimation, quote, and this is from Steve Holland, Director of Research at Home Union, clearly Chicago provides a number of incentives for single-family rental investors. The economy is booming thanks to expansions by a diverse array of companies across multiple sectors, such as McDonald's and Beam Suntory. As a result, vacancy rates are expected, to continue their downward trajectory. Additionally, investors are finding cap rates are at a nearly 7.5%, which is extremely attractive according to these folks. Some bullet points: single-family vacancy in Chicago is expected to decrease by 90 basis points to 5.1%. Rents for Chicago's single-family residentials are anticipated to grow to $1,615 per month, up 1.9% from 2016. Prices for investment homes in Chicago ended the third quarter of 2016 at $172,500, with about 83% of investors choosing to leverage. So there you go. Plenty of headlines pushing Chicago, but I'd say absolutely keep in mind the fact that the population of Cook County is shrinking. Now, given the optimism that you hear in this article, what that may mean is you need to look at more of downtown Chicago versus all of Cook County. If you could get demographic data locally that sort of spells that out to find out what areas of Chicago are seeing growth, more people coming, and what areas are seeing big drags that are pulling down those numbers or inflating those numbers of people who are leaving. like I've said before, in situations like this, it can absolutely spell a great victory for someone, particularly when things are kind of in this weird chaotic state. But you're going to want to focus a lot more on the details of the ground truth in Chicago than maybe with some other places that are a little bit more stable. And the other thing I would put into that is the risk reward expectation. If you don't, frankly, given the other communities we talked about, if you'll remember back, I think it was last week, it must have been last week, we talked about the return on investment of different communities, and we had one that was 17%. Chicago's fine and all, but I would absolutely gravitate more towards one perhaps that have percentages that are on that level or on par with that don't have the same sort of challenges in terms of folks leaving the area. So just something to keep in mind as you're analyzing your options. Also put out by Home Union, Los Angeles rental market named one of the nation's strongest. I figured while we were talking about Chicago, because we brought it up yesterday, we may as well bring up this other area that they think seems to be very hot. The metro area is on track to add 90,000 new jobs this year. And a lot of these areas are actually seeing, to put it in relation to what we were talking about yesterday, are seeing population growths, not people leaving. State of California in a lot of areas is continuing to see negative population growth as a state. But county by county, community by community, you're definitely seeing some areas getting more impacted with growth. And this is obviously one of them. Some of the key points here of why Los Angeles rental market is showing a lot of promise for folks. The metro's employment growth is projected at 2.1% this year compared to 1.7% growth nationally. The single-family rental vacancy in Los Angeles is expected to drop by 10 basis points to 2.9%. That's a vacancy rate of 2.9%. That is ridiculously low. Anything under 5% is a circumstance that validates the idea of throwing a party. And frankly, anything above 10% is still okay, or anything lower than 10% is okay, particularly since that's usually the amount you're calculating for as usually your worst case scenario, depending on the market. At least that's what I do. Maybe someone else disagrees and they go with a higher vacancy rate, but that's what I assume on long-term rentals. Rents for Los Angeles single-family residentials are anticipated to grow to $2,644 per month, up 3.8% from year-end 2016. The median sales price for investment homes in Los Angeles ended the third quarter of 2016 at, and this is a number that's obviously substantially higher than Chicago, $530,000, with 73% of investors choosing to use leverage. So still in that marketplace, you're seeing investors predominantly tending to use not cash, conventional lending there is what's taking up most of it. But that does also show that 25+% is using all cash for their purchases, which can also represent a challenge in terms of competing in those bids to get investment properties. So we're going to go ahead and take a quick break. When we come back, we're going to talk about interesting numbers relating to consumer confidence, interest rates, a few other little tidbits that are, I think, interesting to keep bouncing around in your brain just to advise you and keep you informed to make the best possible decision. So don't go away. We'll be right back after this. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Hello, everyone. Welcome back. Appreciate you sticking with me. Not like you have a choice. You've kind of already got it in play mode. It's just going. But I do appreciate it. Thank you very much. We've got a few more items I wanted to cover today that I thought were interesting. They also do a good job of informing past things that we've talked about, so I thought we could chat about that. Let's see. So number one on the list for today, or at least number one on the list after the break, consumer confidence soars to highest since the peak of the dot-com bubble. Now, this one comes to us from Zero Hedge, but it's not the crazy stuff. It's really just quoting data from reports. It's the Conference Board Consumer Confidence. Broke all expectations in March. They went up to 125.6, with 114 having been expected, the highest number since December of 2000. Both the present situation and expectations soared. Jobs plentiful jumped to its highest since September of 2001. Now, that's an interesting thing to track, right? Because confidence tends to reflect the types of actions that people are willing to take, the kinds of things that might indicate how comfortable you feel with taking on a mortgage, or whether you feel like it's time to sell your home. Now, those aren't always a one-to-one correlation. It's always good to wait for the reports that ask the very specific real estate-related questions. But general rises, when we see general rises in consumer confidence, we tend to see those also bleed into these other things. Now, there's two ways to look at this. There is the great, all right, with greater confidence will come, more activity. We could see things start to go in a better direction. But my concern here is, would a increase in confidence, now keep in mind all the things we've talked about relating to debt over the last few shows. We have now surpassed the level of debt that had accumulated on the shoulders of the population through student loans, what there was in real estate, right? It was at 1.3 trillion when things took a dump last time. It was, and student loans are at 1.31 trillion. In fact, if you kind of track those two things, the housing craziness that led up to 2006, 2007, and the debt growth that accumulated relating to student loans, they're kind of on a similar curve, right? We've talked about all the other things relating to real estate-related craziness in terms of redefining your credit rating. We talked about what's supposed to be happening on July 1st in terms of more changes of things that will be disregarded in credit reports that absolutely should not be disregarded just as a blanket move, which they're going to do. All of these things that are nudging folks who would normally not qualify to borrow to be able to borrow. And let's be very clear. These are folks who shouldn't be qualified to borrow for good reasons. It's not like we're making up goofy reasons like they're the wrong color or they speak the wrong language or they're the wrong gender or whatever. These are simply financial indicators that show they are folks that are a higher risk to loan to, or that they don't have the financial maturity to take on much larger loans, right? And it's not like that's a club that you are excluded from. It's easy to join. You simply spend a few years doing things that indicate you can borrow money and pay it back on the terms that you agree on. It is really not that complicated. I know a lot of people like to complicate it, and some people out there who are lenders do bad things. Wells Fargo is a good example. An article came out today relating to Wells Fargo and their violations that have gotten them in trouble with the Community Reinvestment Act. The list of stuff they did is ridiculously stupid. That would be an interesting show for another time. I would love to get more details on that. The details I've gotten don't give me enough because there's also a downside to the Community Reinvestment Act, which I've covered that in several shows. If you've been a longtime listener, you remember them. You could go to the website, therebelbroker.com, do a search on Community Reinvestment Act. You'll probably have a couple of shows pop up and you can listen to my thoughts on the Community Reinvestment Act. But it is one of the reasons why we had a subprime lending fiasco. And it really got its teeth in 1994 and things sort of ramped up from there. But anyway, so you can go check that out if you like. But in any event, with us setting the stage we've set in terms of debt and in terms of how we have now shifted to a very subprime focused lending scenario to where all the folks in charge clearly believe that the solution to our problem is to create more buyers, when I think over and over again, we've made it pretty clear that's not the solution to the problem. What happens with that confidence? With that level of debt floating around out there already relating to student loans, how comfortable are we with a scenario where folks are confident enough to jump in and start doing the real estate buying thing? Now, if this ends up feeding a whole lot of folks putting their home on the market style confidence, okay, great. I like that. But if not, if it really just feeds the buying machine, I'm worried, because all that does is ramp it up. If with that confidence comes a willingness to take on perhaps more debt than might make sense. So that's why that concerns me a little bit. I would love to just have that be only a good thing, but I think given the wrong circumstances or having it affecting the real estate market in a lopsided way where it really comes down on pushing buyers into feeling confident and moving forward without doing the same on the seller side, that would be a problem for me, which is one reason why I'm hesitant to draw any firm conclusions. But I would absolutely love to see some new data, and we probably should pretty soon, that usually comes out the same time as this data, relating to real estate specific levels of confidence. So we'll hold out for that one and see if we can't make some smarter conclusions. Next, despite soaring rates, U.S. home prices accelerate at fastest pace in 3 years. This is again from the folks at Zero Hedge, simply reporting some numbers, but I wanted to point this out because we've been saying that here all along. All along this time where people have talked about how negatively the interest rates are going to affect things and all these other things, we have seen record growth in prices. So there's absolutely a disconnect. The experts don't seem to get that at this particular level, nobody is stopping their purchase of a home because of interest rates, or at least not anywhere near a statistically significant number of folks. Maybe some people are shifting their buying, changing their strategies. Maybe they're deciding to go with an adjustable rate mortgage instead and buying at the same level. I don't know what else to tell you, but just as I've been saying here, what we've seen with interest rates is not slowing down folks from buying homes. Now, that could change. In fact, it will change if interest rates go to that breaking point. And we've spent a little bit of time on this show trying to figure out, well, where is that breaking point? Is there a point at which we have seen interest rates go up to where it has impacted borrowing in the recent history? No, not yet. And I'm not sure where that number is. I don't know if it's 5%. I don't know if once we go past 4.9% and we actually get that very first time when interest rates are 5%, does that do it? I think that absolutely somewhere in that 4% range up to 4.9, we may see decisions changing in terms of what type of loan, in terms of making that a change of instead of getting a fixed rate, they get an adjustable rate mortgage, or we may see some other jockeying around to try to be able to continue to purchase at the same price point. But I think we'll be able to ease into it. We'll start to see a shift perhaps in buying that will inform us that this is coming and that folks are starting to reach that top point. But I honestly don't know where that top point is. In my head, I got to think psychologically and we'll probably get a point where we'll see a buying frenzy before we see a downturn, simply because if we start to see a consistent growth in the lending rate that goes up and starts inching past 4.5% up towards 5%, there is some sort of period of time in there where instead of it decreasing the number of purchases, it increases it as folks think, I got to lock something in now before it goes up any higher. This is it. This is my end point. I can't go any higher than this. I got to buy now. So we'll see a push for folks to buy properties right now and get it done because we've seen stuff like that in the past. And then that'll dissolve relatively quickly, and then we'll start to see a downturn that will be reflected in terms of a shift in buying power. Folks will be looking, there'll be a lot more pressure on the lower end of prices in terms of lots more demand. The entire curve of home purchases, if you were to have home price on one axis and over time, you would simply see that shift to cheaper homes. If the largest number of homes being sold in your community was say at 500,000, well, it would suddenly drop to 450 or 400 as people just need to adjust their buying strategies based on what they can afford, what they're qualified for. Next, and this one's a little bit off in terms of having discussed these last two topics being very specific to data relating to the housing market. I wanted to revisit the automation thing that we've talked about before. And I absolutely continue to believe that this will be a second industrial revolution that is going to throw things completely to the wind. It's going to be like the guys who used to shoe horses and had to figure out something else to do with their lives because no one was riding horses anymore. The folks who used to fill their truck with ice from some place and bring it to your house and put it in your refrigerator or your ice box. Though that job going to go away. There are tons of jobs today that are going to go away. And we're not talking about in 100 years. I don't even think we're talking about 10 years for a lot of these. I think we're going to start to see this impacting job. We're already seeing it impact jobs. Obviously, automation's doing a lot of that already, but we're going to see a lot of it in the next 5 to 10 years. A lot of the entry-level stuff, menial stuff, we've already talked about how this has impacted construction, where they've got robots that are going to start doing the welding process. We've talked about fast food. We've talked about trucking, with all these various areas where there's going to be automation and huge changes are going to need to be made. Here's another story. Sam, the bricklaying robot that does the work of 6 humans. So now another area, and construction is absolutely an area that can be relatively easily automated, particularly if you're talking about manufactured homes. And I'm talking about homes that are, for all intents and purposes, stick-built homes, but they're just built in chunks in a way so that the broader pieces of it can be assembled on site. I'm not talking about a mobile home. And I sometimes get my terms mixed up between manufactured homes and other styles. But the bottom line is that those are homes that absolutely lend themselves to this, because so much of that is already automated. And then the next step would be automated assembly on the site. And there's actually other robots for that. Now, what's interesting here is this article points out Sam can do the work of 6 unionized masons each day. He never requires a break, benefits, or a paycheck. Now, what's super interesting about this is the companies doing the building don't even have to buy this thing. Each SAM can be rented at a monthly cost of about $3,300 with an average efficiency of 3,000 bricks per day. That breaks down to about 4.5 cents per brick. What is amazing about that is that now the guy who's doing the building isn't also responsible for the maintenance. If you're renting one of these things, you're going to expect it to be up and operating 100% of the time. And if it's not, my guess is that whoever's providing it has already, the contract would include they repair it, any downtime you're compensated for, any amount of time it's not useful to you because it's malfunctioning, you're not getting charged for. It has a, let's see, the preferred, let's see. Meanwhile, using Bernie's preferred $15 per hour minimum wage rate plus benefits. I guess they're talking about, yeah. And it's hard to make a little political point there. A daily efficiency of about 500 bricks brings the human labor cost equivalent to roughly 32 cents per brick, or a little over 7 times the cost. So in other words, you are paying 7 times less with this robot than you would with human workers. Now, of course, right now, SAM can't be completely eliminated, but once you do all the math and calculate in the folks who you have to pay to stand there and keep feeding the machine bricks and all these other kinds of wonderful things, you are still saving 50% from using human labor. So I'm going to go ahead and, of course, as I do with all shows, include a link to all the articles that I've included in today's show. And as I mentioned yesterday, I'm doing the show notes slightly differently, and I'm trying to make it more search friendly. So from here on out, for instance, if you wanted to be assured that if I mention a previous show about the Community Reinvestment Act, you're going to be able to go back and find that. It's not just going to be the tagging of the shows, because there's definitely, I usually tag a show with references like that, but it'll also be as part of the text of the description, so you should be able to find it super easy. All right, folks, I hope it has been some interesting information for you today to bounce around in your brain, see if that doesn't inform the decisions you might make in the real estate world, or maybe to help you create a plan B in case things don't go quite as planned. Thanks again for listening, everybody, and I'll talk to y'all next time.